gentlemen. My name is Felcser. I'm a macroeconomist and the head of the monetary strategy department at the Hungarian Central Bank. So the next presentation, which is following, is pure economics. Sorry for that. I'm going to speak about the current monetary policy landscape which the Hungarian Central Bank is facing right now, but also to connect somehow more or less to the topic of the conference. I'm also going to highlight some of the important international and regional aspects and considerations taken into account by monetary policy decision makers right now. In the presentation, I try to restrain myself to data and facts. If something seems to be an opinion, then it will be my own opinion and not necessarily reflect the official view of the central bank. I need to emphasize this. And now we shall begin. Just a quick summary of the main macroeconomic findings. Presently, Hungary's economic fundamentals have clearly improved in several areas. I'm going to show some of these important areas. Disinflation has been widespread and persistent in the domestic economy, and across Europe it's also a substantial improvement in terms of how the rate of price increases slowed down last year. Inflation peaked in January 2023 in Hungary and then decreased to, and it was above 25% at that time. It decreased to 5.5% by December last year. Therefore, by the end of last year, the rate of price increases returned to the regional range, which is a good development, of course. However, this is still above the 3% inflation target of the Hungarian Central Bank, which means that this inflation, so decreasing the rate of inflation, must continue in this year as well. The last couple of years of very high inflation put inflation back to the focus of central banks and also economic policy in many cases. But of course, central banks not just looking at the inflation developments, but the whole macroeconomic outlook and picture. So considering the growth picture, incoming data suggests that it was subdued in the last quarter of 2023. However, there is some good signs of stability in this aspect as well, as unemployment rate is now low in Hungary, even if you compare it to other EU levels, and the labor market remains tight, which means that it's hard to fill vacant positions right now. Looking ahead, and in terms of growth, economic growth, the central bank's view is that price stability can provide the adequate basis for the revival of economic growth this year, and also for it to take a more dynamic path than in the last 1 or 2 years. And in line with this, the central bank is expected to maintain a disciplined monetary policy in order to achieve this price stability. And then I'm going into some more details first in terms of the macroeconomic outlook. In the external inflationary environment, which this chart depicts, we see that inflation is moderating globally, both in the United States and in the euro area, which is a more closely linked area to Hungary in economic relations. In December, at the end of the chart, we see that there was a temporary increase in the data, both in the US and in the Eurozone, but indicators point to the continuation of the disinflationary trend. So the inflation may moderate further in these economies, while at the lower part of the chart, the Chinese line, in China, consumer prices are even falling compared to the corresponding period of the previous year, which is not a good sign, as one might think. Also, these inflation developments urge central banks of these economies to react in their policies, and both the Federal Reserve in the US and the European Central Bank are expected to start cutting interest rates this year. The last decision of the Federal Reserve was just yesterday. The chairman, Jerome Powell, said that they are strongly committed to returning inflation to their target, which is 2%, but they need more evidence that it's happening in a confident way, so they can be confident that it's happening. And they don't think it's likely that the Federal Reserve will cut interest rate already in March, which will be their next monetary policy meeting, but at some point this year. On the chart, we see the expectations of the financial market participants, what can be expected from what they expect from these central banks. And it shows that it's somewhere around, in the case of the Federal Reserve, somewhere around May, when the market expects the first interest rate cut, and the green dot or sign is what the central bankers think. So they expect a higher path already, and this message had already built-in expectations. So they shifted from the yellow curve to the red one before yesterday's meeting. So it just tells us that it's not curved in stone how central banks are going forward. They are in a data-dependent mode and looking at macroeconomic data as they come in. But from in the external environment, we can expect that these major central banks are also going to cut interest rates following the central banks in the CE region in this sense. Another important new element appeared among the factors affecting the external inflation element, which is a rather new element, and it is the recent conflict in the Red Sea. These developments need close monitoring in central banks as well. The escalation of this conflict may disrupt global value chains, so the shipping and parts won't arrive at the industrial plants. It can already be seen on the right side of the slide that the length of the transport route between China and Europe has already increased by approximately 9 days. And on the left side, at the same time, the shipping costs have also increased by 3 to 4 times, which is a large increase, but these levels are still significantly lower than what we saw in 2021-2022 during the big shock to these chains during the pandemic. And it's also a question how long-lasting these effects will be, but this also made the international landscape more complex day by day. Turning to Hungary, the largest disinflation occurred last year as a whole across Europe, and as a result, inflation reached the lowest level among the Visegrad countries, which are highlighted as yellow on the chart. And also looking forward and going forward, it means that the Hungarian line is the red one. There was a period with relatively high inflation even compared to our regional peers, but going forward, domestic inflation will evolve in line with regional trends in the coming years. Turning briefly to the real economy, one of the key factors to growth is the recovery of domestic demand, that is consumption and investment in Hungary. There are already positive signs. One of these is that real wages have started to grow in line with the return of inflation to this single-digit territory last year. And also the red line consumer confidence is gradually but recovering, but only at a slow rate. Its level is still low. The index remains near the level seen in 2020, the year hit by the coronavirus pandemic. So it's still a relatively low level. But as central banks view generally, the inflation trajectory is key to elevate consumer confidence. We have seen in the past 2 years when inflation jumps, then it has a detrimental effect on consumption and investment because households and firms, due to precautionary motives and because of this uncertainty in the outlook, they cut back their consumption, and the companies cut back their investment, which has a result of lower economic growth in the economy. And for this reason, for central banks, it is their mandate to reduce inflation back to a level consistent with price stability, which is 3% in Hungary. And it is not a mission impossible. We saw this before the pandemic. Between 2017 and 2020, the average inflation rate in Hungary was just 3%. So it's a goal that can be achieved and that can be maintained. These are some factors that are channeled into monetary policy decision-making in Hungary as well. As I said, the economic fundamentals of Hungary are improving. On the right side, one of these important fundamentals is the continuation of the decrease in inflation towards the 3% inflation target. We expect, according to our latest report in December, that this will continue in the first quarter before it will slow down a bit, but the inflation target can be achieved persistently, so not just in a temporary way, persistently from next year. But even this year, inflation will be much lower what we experienced in the recent years. And also the external balance of the Hungarian economy, the current account balance, the trade, and also the financial flows of the Hungarian economy is improving substantially and also faster than expected previously. And also from the international side, there are improving fundamentals. The external inflation environment is also better than expected. And the overall financial health is in a good shape, we can say that. On the other hand, the risk environment warrants a careful approach by central banks and also by the Hungarian Central Bank. We see and we can read it in the news as well. There are intense geopolitical tensions. The Red Sea is just one of them. There is war and there are wars escalating or already underway. The commodity markets, so the energy prices, the prices of food commodities, they decreased a lot last year, but there are still risks that they can jump again if something happens, especially in case of global commodity products like oil or gas. These shipping issues can affect them very heavily. And also in terms of domestic developments, the Hungarian Central Bank made efforts to make domestic financial markets stable, and they stabilized last year and at the end of 2022. But there are also some uncertainties in terms of market developments that we have to take into account. Overall, the monetary policy strategy has some key elements. the central bank aims to achieve an interest rate path, the lowest possible path that ensures the price stability so that inflation returns to 3%, around 3%. And meanwhile, financial markets remain stable in Hungary. And through this, the real economy can go on a more dynamic trajectory, and also market-based lending can restart after in a lower interest rate environment with a higher confidence by economic actors in the outlook. The goal of the central bank remains unchanged. It's our mandate to reduce inflation further in a sustainable way and reach price stability. But as the economic environment is rapidly changing, and for some macroeconomic data we have quarterly figures, for GDP, for example, for inflation we have monthly figures, we prepare forecasts quarterly, but these risk environment figures, so different financial markets, we have not just daily data, but we have data in every minute, and there can be large shocks and tensions happening. And when it starts to become more system-wide and serious, then the central bank definitely have to take it into account. And therefore, the central bank monitors closely these developments and also continuously monitor the relative developments within the region, and also what the economic actors are expecting, how the economy will develop. The four most important character elements of Hungarian monetary policy has remained the same for quite some time. The first one is the importance of the inflation target. Inflation is likely to move close to the upper bound of the tolerance band. So we have a 3% inflation target and a plus minus 1 percentage point tolerance band, which represents that the inflation may fluctuate around the target. It's a very hard challenge to pinpoint inflation at exactly 3%, but inflation is expected to move close to 4%, so the upper bound of the tolerance band in the spring bands already, and then, as I said, reach the target persistently next year. A condition for reaching price stability is ensuring financial market stability. The decision-making continues to be data-driven to achieve both the inflation target and the maintenance of financial market stability, taking into account the inflation and macroeconomic outlook, as well as developments in the risk environment. And finally, communication in advance is a very important feature in today's monetary policy conduct. So it remains a crucial, important part of the Hungarian monetary policy character as well, and its effect can be felt in expectations, as the current interest rate path that is expected, for example, by market participants, is also feasible, is deemed feasible by the Hungarian Central Bank. So it was just a quick summary. Thank you for your quite kind attention, and I will be around during the day, so I will be more than happy to go into more details if someone is interested. Thank you very much.